Hey everyone, welcome back to the Daily Gold Podcast. Today we're chatting with David Skarica of AddictedToProfits.net. And Dave, very kind of you to join us today. We're just to let the listeners know you're using your satellite connection because your regular connection is out, so there might be technical difficulties for a second or two. But let me get right to it, Dave. Gold and the precious metals, very nice day today, especially in gold. People have been wondering, is it going to break lower? Is it going to break higher? What I like about the action today and just in the last month or so, Dave, is a lot of the global equity markets, they're starting to look pretty bearish. They look kind of toppy. They've shown a lot of weakness, and gold failed to break support, so we had a nice move to the upside today. What are your thoughts on all of this?
Well, see, I'm really liking the consolidation pattern in gold, where we're continually holding that 1500 to 1525 area on the downside. And, despite, like you said, the bad news out of Europe, China and India slowing down, all the things that you think would probably cause some selling pressure in gold, these things continue to allow gold to, gold continues to absorb them. And I think you get to the point, especially in the Euro crisis, where you start attracting capital into the gold market when that happens. We saw that, for example, last year when when that euro hit that 119 level. What we saw was gold actually started rallying when the dollar was going up and the euro was going down because it became kind of a fear trade. So I would think that unless you got really uncontrollable equity selling, that you would definitely see that kind of turn where the strong dollar is more indicative actually of euro weakness, and that has gold attracting capital. And then seasonally speaking, last year was a little out of whack because we got this top in gold in the summer. But we're actually seeing the more typical gold trade where gold tends to bottom and gold stocks tend to bottom in the July to August period. And this is usually followed by a rally into the fall, followed by a pullback sometime into November. And then the big breakout happens afterwards. So right now, I would say in the short term, if the Amex Gold Bugs Index, the HUI, can break the 405 level in a short-term trade, it can probably get closer to the top end of its trading range here. And if we break the 464 to the upside, which we're a good ways away from right now, about 15% away from, and it looks like we have this phenomenal bottoming kind of pattern in the 372 to 464 range on the HUI. And because some of the metrics of, like gold compared to the HUI or just basic price to earnings ratios and those sort of things are so cheap. I mean, like we're getting back to those 2008 levels in a lot of gold stocks. It's hard for me to see, even if we get some kind of big banking crisis in Europe in September and October, it's hard for me to see these gold stocks really, really tanking. I guess another 2008 could happen and they could drop another 30-40% from here, but I really doubt that. I think that probably at the very worst, the mid 300s in the HUI would represent very, very good support.
Hey, let me just follow up on the European situation in regards to precious metals, Dave, because obviously accelerating banking crisis there is possible, and also you look at what's happening in Spain. They appear to be in a lot of trouble. They're going to need a bailout soon. Maybe Italy is next. The ECB or whoever is just going to have to come in and monetize this debt at some point. And so, as we know, these events are very deflationary in nature. And then when the authorities come in and put some backstop to it, that's what benefits precious metals. But I'm just wondering, are we nearing the point when these potential actions could be discounted positively for gold in advance? And the reason I say that is because I'm sure you've heard this. So many times I'm hearing, we need a QE3 or maybe QE3 will move gold. Markets, they're forward looking, they discount things well in advance. It seems to me like precious metals would likely bottom and start to move up a little bit in advance of such potential policy.
Here's the big difference between now and 2008. Like if you go look at okay, I'm getting away from precious metals for a second, but just to show you how I think the makeup and the mentality of the market is different. Go look at the EWI or the EW, that's the Italian iShares or the Spanish iShares or any of those kind of European countries that are in trouble. The Greece market or the whatnot. They are all dropped, say, 50% from their 2011 highs. And a lot of them are down between 70 and 90% of their all-time highs. So unlike, say, 2007, 2008, when we were kind of just coming out of the frothy levels of the bull market, most of that has kind of been baked into the cake in terms of the equity markets. And the reason I think this pertains to gold, because I just think that if you do get a Greece default and then you have to have a bailout of Spain and Italy, say vis-a-vis like some kind of money printing scheme, if you do have that, I just think that the gold, precious metals, and those European markets have really discounted a lot of those worst case scenarios because they've dropped so much going into that. So those actually events would actually probably bring a relief rally, and we would go significantly higher. So I agree with you. I think the real difference is, and in gold, remember in 2008, like the stocks essentially did a topping process between March and July in 2008. This time, the gold stocks peaked out late last year. I think it was in about September of 2011. So we've been dropping for roughly 9 months on the gold stocks. So, and gold itself peaked out last August. So, we've been, so we're in a year-long consolidation in that. So I think this time around, we're just seeing much more of that kind of discounted in the market. And we're even seeing, like, if you kind of look at the CCI index, and we've seen commodities actually have, and part of it is due to the drought in the agricultural commodities, but, we are seeing a nice little bounce in commodities as well. So I think this time around, rather than this big crash, we could see 5, 10, 15% downside in equity markets, and I think we will see that actually, but we're really discounting more of this kind of crash type or kind of crisis type scenario. I would think actually one of the markets the most vulnerable is the U.S. right now, just because it has held up so well. That the S&P is at 1350 or 1330 or something, or 1330 1350 range, and the high is roughly 1400. So it has dropped not nearly as much, and it's kind of like the emerging markets in 2008. They dropped a lot to kind of catch up with everybody else. I think the U.S. market would probably have to drop to catch down with everybody else. Or if it didn't drop a huge amount, when this turn comes, gold, precious metals, commodities, European markets would probably greatly outperform the U.S.
Yeah, I definitely agree with that. And just to go back to, the difference between the setup in markets right now versus 2007, 2008. I mean, the other thing is, look at the strength in bonds. I mean, bonds were not that strong in 2007, and even in early 2008. I mean, bonds didn't really begin to explode until, I think the end of Q3 or even Q4 2008. So, I mean, as you're saying, I mean, if you look at the bond market, I mean, it's already discounted, and not just in the U.S., but also in Europe and in Japan. I mean, it's already discounting at the least a mild recession, and so that's, I mean, what is this setting up for when we're going into a mild recession, and the bond market is becoming a very crowded trade globally? What is that setting up for? When authorities and policymakers start to fight the recession, they fight the bear market, so to speak. I mean, to me, that just seems to be setting up for a lot of money moving out of bonds and then back into the resource sector.
Yeah, I would just think that, like, and I talked about this with you off air beforehand, like European banks supposedly had something like 10 times the position, 10 times the position of in emerging markets that U.S. banks have. So essentially, because of that huge position, now that they have to raise capital because they have problems, essentially liquidity problems, they're having to sell those markets, and those markets are selling off. And of course, once some kind of fix can hopefully be found for the European, like some kind of European TARP can be found, that money can then flow back into those risk-on trades, and you can see that kind of turn to the upside. And of course now, one reason you see that pricing in of the recession on the U.S. side is this whole worry over the fiscal cliff and the tax increases and spending cuts that automatically kick in if they can't agree on anything. And, some of the Democrats in Congress and the Senate have said they're willing to go over the cliff. And I don't think that's going to happen next year. I still think ultimately that's the kind of solution you need to the debt problem in the United States. But I think they can still put that off for another year or two. So I think you won't have the fiscal cliff. Hopefully Europe, if you do get some kind of Grexit and Greek default this fall, which makes them deal with their banking problem, hopefully that will lead to this kind of you know you know this kind of uh, rebound in the markets, which will ultimately then lead to the move into risk assets. And I still don't think you're going to get a 2008, even if you get a Greek default. Like unlike 2008, when Fannie Mae and Freddie Mac and Lehman Brothers and everybody was like uh, taken aback by how many of these things were going under. I think a Greek default is about the most anticipated default in the history of mankind. So again, I see more of a relief rally occurring from that in everything rather than this kind of doom and gloom, like just total collapse scenario.
Yeah, I would agree with that. Dave, before we close, I mean, there's a lot of people who, they call themselves contrarians, just because they're in precious metals, and I mean, that's all good and fine. But, Dave, I consider you a real contrarian because, recently you've been telling me about, what the real contrarian trade is coming up. And, just the one thing I'll mention before I get to you is, there's not always going to be contrarian opportunities every day, and every week. I mean, you really have to wait for, these once and every several years type of opportunities. And so, Dave, why don't you just talk about, what you feel the outlook is in Europe, not necessarily in the short term because we know it's still a mess. There's still some downside. But if you're looking out over the next several years, what do you see there as far as Europe and contrarian opportunities?
Yeah, if you go to my website, you'll see I actually have a video on buying what Sir John Templeton used to call maximum pessimism, which is essentially buying markets when they're crashing. And I'm really, really bullish on Europe right now because I believe that is where the maximum pessimism is. Now, I'm not buying yet. I still think we could see this, smash lower into the fall. And something like 80% of debt and banking crisis start in September. So I think that could kind of launch another maybe between 10 and 20% downside on these European markets. And maybe even, we go lower than we are today, obviously, on these European markets. But I think if you look at the valuations in Europe, they're like the 1982 valuations in the United States or the 1974 valuations in the United States, where you're getting those single-digit PDEs, you're getting very high dividend yields. And we're talking forward PDs, by the way. Like I saw a stat today that Italy, for example, is trading between 7 to 9 times the forward PDE, even with earnings being ratcheted lower because of the recession in Italy. So we're just seeing that really, really negative sentiment out there. So I think that buying Europe this fall and probably over the next year is the real contrarian trade. Now, I'm not saying that Europe, I don't think they're set up to start a 15 or 20-year bull market, but I don't think there's any reason that they can't have a huge 2 to 3 year rally or 4-year rally, similar to, say, what the U.S. had in the early to mid-30s or mid-70s off these kind of lows. And actually, the most contrarian of my trades is I actually want to buy Greece. I only want to buy Greece if they're forced into some sort of default, and especially if they're forced into leaving the euro and then going back to the drachma and devaluing. Because that, if you look at the history of past defaults like Argentina in 2001 and Russia in 1998, markets perform wonderfully in the 3 to 5 years that follow such a default. And usually within a year or two, the economy starts growing again. So that's kind of my ultra contrarian trade right now. And I love gold and precious metals. One thing I've talked about too is that, and we'll talk about this more maybe in our next podcast, is that you usually see a 4-year cycle in gold precious metals. I think there's a major low in them. But as much as I love gold and precious metals, like in 2009, you were better off buying casino stocks than you were gold and precious metal stocks, even though gold and precious metal stocks were fantastic and a great place to be. So I love gold and precious metals. They're undervalued. I would buy them. But I have to say my ultra contrarian trade right now is buying Europe, especially if in the next 6 to 12 months we see a Greece default and exit from the euro.
Hey, come on, Dave. This is a gold podcast. Nothing's better than precious metals.
Yeah.
You're.
In percentage terms, now is the only thing that might rival it is buying some cheap juniors. But the one thing I've learned, and I've learned this the hard way, you only buy juniors when the market's like this. When the market's hot, I ain't buying any juniors.
All right. Well, Dave, on that note, I think your comments about what's going on in Europe, especially if people have a lot of patience, and they should really be watching Europe closely in the next several quarters, because there really could be a generational type of buying opportunity in European equities. And let me just get a final comment, Dave, because I mean you were talking about, like in the 30s, and we had a rally there, but could it could also be similar to perhaps what with the the kind of cyclical bull we've just seen in the U.S. I mean, things got really oversold there, with the banking crisis and all of that in early 2009, and then the market totally turned around. And why don't before we leave here, why don't you give like an example or two of a couple conventional type of stocks that from their 2009 lows had. I mean, these things didn't just double or triple. I mean,
I'll actually give three. One was one stock that I bought, which was Tata Motors, TTM. At that time, they were just about to release the Nano, the world's cheapest car. And, India still has a long-term growth story. And the stock, because they had done takeovers of Land Rover and Jaguar and taken on some debt, people were worried that they'd be able to survive. But I knew this was India's largest car maker. At the very worst, they were going to get a bailout from the Indian government. And that stock went from $350 to as high as $35 and still trades at about $20 today. Another one was Ford Motor Company, same thing. Like, who would want to buy a motor company during the debt crisis? GM went bankrupt, highly indebted, big slowdown in the credit markets, and Ford went from $1 to $15. And the final one was, I talked about casino stocks, and this is one I really regret not buying at the time. I did a presentation about these stocks, but I didn't put my money where my mouth was in terms of this stock. Was that the casino stock, same thing, high, a lot of them overexpanded during the bubble, had huge debt loads, and Las Vegas Sands went down to $1.30 a share and it was at something like $150 a share, before the bust. And it eventually went to $60 a share this year. So that's the kind of thing you can get in these kind of maximum pessimism moments. And if you just put a small amount of money into these kind of trades, like if you would have put 10 grand into Las Vegas shares, it would be worth over $600,000 today, or at the top of the market. It would still be worth nearly $400,000 today. So that's just the kind of thing that you can do. And then, by the way, if these companies turn around and begin to pay dividends, your accrued annual dividend can be huge. Like, that's how Warren Buffett's made his money. That his original Coca-Cola position is paying him something out like 30 or 40% a year, because the dividend has climbed over the last nearly 40 years since he bought it. So that is to me where I really, really want to look buying. And if you want an example of this in the precious metal arena, all you have to go back to is one of the stocks I have actually owned since the beginning of the bull market was Eldorado, Ego. And I bought that when it was a penny stock back in 2001. And again, my accrued, now that's not my entire position was down there, unfortunately, but from that little tiny bit that I had in that initial position, my accrued dividend every year is 30%. So I have no interest in selling that position, because let's say you have 20 grand, for example, in that position, you're getting $6,000 a year in a dividend on that 20 grand. So it only takes you 3 years to get your money back. Every 3 years, you're essentially doubling your money in that initial position. So that is the advantage of buying these markets and being willing of taking advantage of these, or markets when they crash. Now, sometimes you're going to get burned. You could have bought a GM and it went to zero. But even if you bought 2 or 3 stocks that do that, the one that pays off is really going to make it worthwhile in the end.
Yeah, Dave, that's an excellent point there about the dividends. And just to give a plug for your service, I know you're focusing on individual names in Europe. So we'll just, for listeners out there who are, seriously interested in, not only getting this kind of analysis on Europe, but also learning of, some of the particular blue chip companies over there that have been severely discounted, Dave provides us in a service.
Yeah,
all right, Dave.
I was doing a special offer at the beginning of the month, where I was basically giving people, I did 3 special reports on the European debt crisis and how to profit from it. And I was giving people 3 extra months on the subscription. Now, if you write me an email and say that that's offer's closed now, but if you do write me an email, say you're one of Jordan's, you heard this podcast, I'd be more than willing to give people access to that offer. That's no problem whatsoever.
All right. Well, Great, Dave. We thank you for that, and thank you for your time today, and look forward to chatting with you again the next couple of weeks.